Accenture delivered 192% returns over the last decade, but in the last 5 years, just 14%. So what's the deal here? Is this company worth digging into, or should we just move on? That's exactly what we are finding out today. Because here's the thing, time is your most precious resource. You can't analyze every single company in depth. You need a system to quickly separate the promising opportunities from the ones you should skip. That's why I've created this 3-minute analysis format. We look at all the key metrics in just 3 minutes to answer one simple question. Does this company deserve more of my time, or is it a pass? So let's start the clock and find out if Accenture makes the cut. Looking at past performance, the 10-year returns of 192% are solid. But the 5-year returns of just 14% tell a different story. The growth has clearly slowed down significantly in recent years. Moving to investors, insider ownership is basically zero. That's concerning. However, we have 6 super investors holding this stock, which shows that smart money still sees value here. Now, financial health, and this is where things get interesting. Return on invested capital at 32%. That's exceptional. This company knows how to deploy capital efficiently. Net profit margin at 11.3%, solid for a consulting business, though not spectacular. Share buybacks are negative at 8.9%. That's actually reducing share count, so it is great for the shareholders. And years to pay debt is just 0.5, basically no debt concerns whatsoever. Looking at the graphs, we can see that this is a financially healthy company. Growth metrics are moderate but steady. Revenue growth at 7.4%, free cash flow growth at 10.5%, slightly better, showing good cash generation, and earnings per share growth at 9.7%. That's solid growth. The revenue and earnings graphs show a steady upward trajectory without major volatility, so this is a predictable business. Dividend yield is 2.3%, not high but respectable. Payout ratio at 42.4%, very healthy with plenty of room to grow. And here's the impressive part. 5-year dividend growth at 17% annually. The dividend has been going up steadily, as we can see on the dividend history graph. Now for valuation. Our DCF shows 3 scenarios. The value at the low scenario is $275, medium $317, and high one at $365. With our 30% margin of safety applied, we get a range from $193 to $256. Our analysis price was $252, and the current price is lower at $240. The average intrinsic value with margin of safety is $223. This shows a current downside of about 7%, meaning the stock is very slightly overvalued based on our conservative estimates. It's probably fair to say that it is somewhere close to fair value. Looking at the overall picture, we get a score of 1.6 out of 3. The strengths are clear: exceptional financial health and excellent dividend metrics. This company is a cash-generating machine that's returning value to shareholders through buybacks and a growing dividend. The weaknesses? Past performance has slowed significantly and current growth is moderate. But when it comes to the valuation, it is close to fair value. So, is it worth digging deeper? That depends on what you're looking for. If you are a dividend growth investor who wants stability and predictable returns, then yes, this one deserves a deeper look. But if you are hunting for undervalued opportunities or explosive growth, this is a pass. And that's exactly what this 3-minute format is for, helping you decide where to spend your time. If you want access to Analysis Library, where you can find data from all my analysis and can run these quick evaluations yourself, become a Patreon supporter. The link is in the description. Thanks for watching, and I'll see you in the next one.